I'm Lawrence.
I'm Uzair.
We're two university students trying to plan our future and create success.
Today we're going to be having a discussion on student investing.
Welcome everyone.
This is Thinking Ahead.
Okay, so I think this is a topic where people are kind of, especially university students, are a bit divided because you have the people who are already know a lot about investing and already getting into it, or they're quite literate financially, and then you have people who have just never even touched it, haven't started saving, zero in the bank account kind of thing, live paycheck to paycheck. So why don't we explain to them people who haven't invested, why is it important to start now? So do you want to start?
I think one of the reasons we advocate for investing so much is it might seem like not that big of a deal right now, but down the line, the amount of money you invest could compound into something so much bigger that you'll regret not investing a year before or a few months before, you know? And as college students, we've started earning our first paychecks. We've started becoming independent. So why not start now, is what I say.
Yeah, I think investing is something where it's really just about planning your future. It's whether or not you want to have a stable future or not. And especially if you have a bit of disposable income, if you start investing it now while you're a lot younger, it's going to go a lot further when you're older.
And I was wondering, how can it... And a few friends of ours asked us, how do we get started on investing? And we've definitely helped a few friends out personally. And we feel like this video will just break down the basics of what investing is, what do people invest in, how can you start investing as a college student on minimum wage?
Yeah. Okay. So the main concept that we need to get across is compound interest. And it's very simple, but it's very, very powerful. You can type in any numbers on your computer. If you just type in... If you just search in on your computer, compound interest calculator, you can put in your own wages or your own amount of money and see how much it will make you. So it's a very simple rule, and it's basically where, let's say that your investment grows by 10% each year. If you have 10% on, say, $100, you're going to have $110 at the end of the first year. But then when you get 10% at the end of the second year, you're going to get 10% on $110. And basically what happens is it slowly grows and grows and grows and grows until eventually you're left with a very large sum of money.
It's an exponential graph, essentially. So you start out with something really small, which might seem like an insignificant amount to you right now, but 20 or 30 years down the line, it'll be worth so much more. And I think it's a good idea to understand what compound interest is, because that helps you not just use money in the right way so that you have the maximum value from it later on down the line, but also it helps you understand the value of money. So you won't be spending money on meaningless things, you know. So for example, if you're going to be spending €5 on Starbucks, for example, you might remind yourself that $5 now, if you were to invest it 30 years down the line, will be worth 70 or 80 euros.
Yeah.
And that reminder helps you keep your budget in check, helps you be more disciplined with your money.
Yeah. So a good example of compound interest is if you put away $100 every month for 25 years. So this would take you to the age of, in your 40s, your mid 40s. And it was at an interest rate of 10%, which is relatively standard for the current investments on index funds. But we'll talk about that later. Basically what you'd have is you'd have $120,000 in 25 years. And if you look at the actual investment that you put in over that 25 years, the $100 every month would be about $30,000. So what you see is that your money has basically quadrupled over 25 years.
Now that we've talked about why investing is important and the benefits of compound interest, maybe we should start talking about how students can get started on investing. So you've been investing for a while. Maybe you could tell them what exactly you started with and how exactly you're doing right now.
Yeah, sure thing. So basically I started about a year ago in March. And what I did was at the time I had a job before I came to university and I was still living with my parents. So I had some disposable income. And what I did was I decided that I'd put a chunk of money away into index funds. And then about 6 months in, I started looking up how the stock market works, investing in individual stocks. So then I put some money into stocks as well. And then finally, about 3 or 4 months ago, I started reading a lot of books on cryptocurrencies and crypto assets. And then so I made my portfolio more diverse and I put some money into that. If you were to start investing, I mean, is there any tips we can say about someone who's starting on, maybe they have a part-time job at university, they're making maybe $300 a month or something like that?
Yeah. So I think when you get started on investing, you don't have that much money in college. I think you should divide your money up into 3 sections. You should have a section for all your needs and necessities and all the expenditure that you need to save money for. And the second part is saving your money. So you should have like a good income saved up in case of emergencies, or if you want to go to a trip or a vacation perhaps, or maybe even pay for college later on down the line. So that should be like the second half, and then the third half should be investing. And I think the difference between saving and investing is that the money that you're putting away for investment should be thought of as long-term investment. It should be low risk, high reward, and we're not going to be removing that money for another 10-15 years. So you should kind of act like that money doesn't exist anymore. So anything that you feel like you're going to need in the next 2 to 3 years, you should keep it in cash with your savings, and anything that you feel like you won't be needing for the next 2 to 3 years, you should start investing it.
Yeah, I think it's a really good point that you touched on that actually, because like you said, you have like the short term and you have the longer term. And we should make it clear now that if you are going to invest in stuff like funds, index funds, they generally you're not supposed to be touching them, because every time you draw the money out, you're going to be taking a cost. And so with investing, you really got to be looking at the longer term. And so any money that you do need relatively immediately, like we said, up to maybe 2 or so years, you should have and keep that in your bank account.
And I think especially when you're getting started on investing, your aim should be to understand long-term investing. A lot of misconceptions around investing are that they are very risky. Like you shouldn't be investing in stocks because it's very volatile. You might lose your money. But with long-term investment, those risks are actually very low. It's quite stable, and you're 90% of the time guaranteed to make money. And that's what we are trying to advocate for. We don't advocate day trading. That's very risky, and it's very similar to gambling. And unless you really know what you're doing, you shouldn't be getting into that.
Yeah, exactly. So maybe we should start by explaining some of the basics. So the first thing you'd invest in would be what?
The most important thing that I think most people should be investing in are mutual funds. So what you have are essentially funds, and funds are not like individual stocks. You can think of a fund as a basket which has 200 to 300 individual companies inside that basket. So you're not putting your eggs in one basket, literally. You are not investing in one company. So if one company goes down, then your whole investment doesn't crash with it. You're investing in 500 companies. And on an aggregate, if some companies go down within that basket, some companies will go up. And in general, the net result is always increase more than decrease. So in general, you'll be always, more companies will go up than they'll go down. And as long as you keep buying those funds for like 10 or 20 years, there's always going to be an increase. For example, the S&P 500, which is the most popular fund.
What's the S&P 500?
The S&P 500 is essentially the fund which consists of the top 500 companies in the American stock market. So that consists of, you're investing in the top 500 companies in America. So that way, if some companies go down, there are always other companies that go up. And in the long run, the world economy always improves. So the fund will generally follow the trend of the world economy, because America is such a big player in the global economic scale, right? So in 20 years or so, the S&P 500 has never gone down over long term. So of course, there can be fluctuations where over 1 year it'll be high and 1 year it'll be not making as much profit. But if you keep your money in there for 20 years, trust that the money will increase. It will always increase, because trend just says it has in the past.
So just like Uzair said, if you're looking at funds, the main thing, you don't even have to, you just have to pick the fund. The fund itself is being managed by an investment company, and they're picking out specifically the companies that they think will do best over the long term. And then you in yourself are just putting your money into one place. They are then taking your money and dividing it up into all of these different companies.
Yeah.
And I think another important thing to say is that even in the case of a recession, so let's say like the 2008 financial crash, obviously all the companies or the general world economy is going to be slightly lower. But then because we're investing over the longer term, like we were saying before, it's all about like 10 to 20 years. That risk is then going to be mitigated by the fact that over the next 10 years following, for instance, the world economy is going to grow and recover.
Mm-hmm. Yeah, and I think one of the biggest mistakes people do is they invest in like a year or two, and when the stock market crashes, they remove all their money.
Yeah.
But that's what you should not do. You should hold on to it as long as possible and trust the market.
Exactly. Yeah. So the main thing here, like we said, you put your money in, you leave it. You don't really need to look at it. Some people look at it maybe like once or twice a year to see how an investment is growing. But the main thing is that you're confident in it. You can leave it be, and then you come back to it in 10 to 20 years, and you've got something which is substantial, and you can use that money to buy a house or to do whatever.
Mm-hmm. Or retire.
Yeah.
Yeah. One more distinction that we'd like to make is there are funds. So that's what we talked about. So there are mutual funds and exchange traded funds, and the difference between them is that exchange traded funds are essentially funds that are traded like a stock. So you can buy them now, you can sell them tomorrow, and you kind of treat them as a individual stock. Whereas with mutual funds, you treat them as something that you're going to hold on to for long term. So if you buy it now and you want to sell it, then you need to put in a 2 weeks notice before you sell it.
Yeah.
And that's why we recommend you invest in mutual funds, because although there's no real difference between an exchange traded fund and a mutual fund, the thing with mutual fund is that you'll think twice before removing your money, because it is such a hassle to remove your money from it, you know?
Yeah.
Whereas with exchange traded funds, it's very easy to remove your money, and Murphy's law states that whatever can happen will happen. One day you might just wake up and feel really anxious that the stock market is down, and you might accidentally press the sell button and sell all your fund money, and that way you lost all your money. Whereas with mutual funds, it's kind of like an extra layer of insurance and a protection that prevents you from making these impulsive decisions.
Yeah, it makes it harder for you to draw out your money, so you can't just put it in, take it out. It's like we said, you're leaving it for the long term.
Mm-hmm.
And I think one of the things that's very important when you come to investing is that it's not for just adults. When you're starting university, when you're still at school even, as long as you're 18, you can open an account. But it's not for people who have like full-time jobs, they already have a house, they already have a family. You have to start now while you're younger for it to work than when you're later.
Yeah.
And I think one example is if you're looking at, for instance, buying a house, you're going to need to start saving maybe 5 years in the future before you can actually buy that house. So if you start planning it now while you're 18 or while you're 20, you can get that house by the time you're 23, 25. And if you leave that money in long term, you could probably pay off that house by the time you're 35, which is 20 years younger than most people.
Mm-hmm.
So it's all about planning. It's all about thinking ahead. And the more you think ahead, the more smart you'll be with your money. And the more smart you'll be with the money, the more abundant the money will be, basically. So now that we've spoken about funds and what they entail, maybe we can talk a bit about stocks, yeah?
Yeah. So essentially, the first line of investment is always funds, because they're always so secure. They usually go up in the long term, and you shouldn't really worry about them.
Yeah.
But with stocks, there is a lot more risk involved, because you are now putting all your eggs in one basket.
Yep.
And now you are investing in this only one company, and all your hopes are that this company goes up. And if it crashes, all your money goes with it. But with stocks, it is high risk, but there's also higher reward.
Yeah.
In general, funds will go up by 8 or 10% every year.
Yep.
But stocks can sometimes go up 1,000, 1,500% a year. As we saw last year with the case of Hannure, for example. It went up a few 100%.
Yeah.
And even Tesla went up a few 100% as well.
Yeah.
So there is higher risk involved, but there's also high reward. But one way you can invest in stocks in a more safe way is to invest in established companies that the world relies on, and companies that you think will not be going anywhere in the next 10 or 20 years. That way you're investing in a very stable company, and again, the risk is much less.
Yeah, I think the best way when you start with stocks is start with really small amounts of money. It can literally be $1 per stock. And what you should be doing is that if you take that money, put it on the stocks of the companies that you believe in that will be successful, say some popular ones, Apple, Amazon, Tesla, and watch that over the period of several months. And then you can still see how much them stocks have grown since your initial investment. So even if you're investing $1, you can then look at it and see, oh, this actually grew 20% over like the last 6 months. And now I've got $1.20. And you go, okay, well, I feel a bit more confident about this. I know that they're not going to go downhill in the future, and I know that they're slowly going to progress. So what I'm going to do now is that now I'm going to start investing a bit more than that. So maybe you're investing $100 or something.
Yeah. And I think with stocks, it is a lot more valuable in the short run. So I think with stocks, you can obviously hope to invest in the long run. For example, if you were to invest in Google, you'd know that it's probably going to be around in the next 10 or 20 years, and you can hopefully keep the money in there, and in 10 or 20 years, the money will eventually grow, similar to the way mutual funds work.
Yeah.
But you could also invest in Tesla now in the hopes that in 2 or 3 years, electric cars will be more popular and Tesla will be more in demand. And hence, in 3 or 4 years, your money will already be significantly more than what you invested in.
Yeah.
So it's more short term, more reward, but it is also a slight chance that the company fails.
Yeah.
And your money goes crashing with it. And that risk isn't there for mutual funds.
Yeah. So because it's so, like you said, so it's medium term normally. Although you can hold it for the long term, and you can also trade it in the shorter term as well. Like in the case of the recession that we talked about earlier, in the same way that mutual funds, because you're holding it over a long period of time, is not really a liability. With stocks, on the other hand, take them stocks out anytime soon, and you're in the middle of a recession, you are going to lose a lot of money. And that's one of the main risks, is either a company doesn't do too well, or a recession comes and all of the stocks plummet.
Yeah, but I think even though the stocks plummet, I don't think a good strategy would be to remove your money then.
Yeah.
As long as the company does not crash completely, I think you should hold your money into the stock, and just hope for the best. Hopefully the company revives after the recession and does really well, as we saw in the case of 2020, where like there was a recession, companies didn't do too well, and then all of a sudden we had a bullish market, which was the highest that American history has ever seen.
Yeah.
And a lot of companies did amazing,
Yeah.
So you'd regret if you'd have sold your stock when there was a recession.
Yeah. And the main advice that I'd give when it comes to buying stocks, and it's very, very simple, but it's surprising how many people don't follow this, is buy it when it's low. So buy it when the stocks are cheap and undervalued, and sell it when it's high. I think most people jump on the train of they see a stock going up and up and up, and so they go, oh, the stock's going up, so then they buy it while it's on the way up. But really the amount of money that they can make is probably not as much as if you were the person who bought it before it started going up. So it's always important to keep in mind, buy it when it's low, sell it when it's high.
Yeah, but I think we need to understand that a lot of people are not very well versed in what the stock market is doing, when it's going to go up. So obviously you need to have some understanding of the stock market, some understanding of the economy, what companies are doing. But you should also understand that just as common sense, that if the stock is going up, don't invest. Wait for it to dip, and then invest. You know, that's like a good strategy.
Exactly. Nothing grows forever. There's always going to be a dip.
Yeah. All right. So the third thing that we'd like to talk about in investing is crypto. So I don't really know much about that, but maybe Lawrence, you could tell us something about crypto.
Yeah, sure. Crypto is one of these buzzwords that everybody has been using lately, especially in terms of Bitcoin, blockchain, Ethereum, and I think it's very easy for lots of people to get confused what they all mean.
Yeah.
The crypto market works in the same way as the stock market, so you can buy, you can trade, you can sell, just like you would in stocks. The difference is what you're selling is a crypto token or a cryptocurrency. So the main ones, you probably have heard of these, right? So like Bitcoin and Ethereum. They're the biggest two. So Bitcoin has about 80% of the market share, and Ethereum has about 18% of the market share. So together they take up the majority of the crypto exchange. So why would people invest in crypto over traditional stocks?
With crypto, right? So obviously there's a lot of hype surrounding it, but we need to understand that from a futuristic perspective, seeing where the world economy is moving towards, traditional currency is becoming more and more obsolete, and most economists and most computer scientists, etc., understand that crypto is the way forward.
Yeah.
So as we have gold now, we'll have crypto, we'll have Bitcoin to hold value in the future, and that'll be a more stable form of holding value and more secure in some ways than gold is.
Yeah.
And that's what the future is looking like right now. So obviously we need to get in right now while there's a gold rush, and it is very it is very volatile because crypto goes down and up, and as we've seen, Bitcoin's at an all-time high right now, but a few years ago it was like an all-time low, and that fluctuation is very scary to some people. But again, the reward is also very, very, very high, more substantial than any stock or any mutual fund could be. And if you take that risk right now, chances are that that risk will pay off in 10 or 20 years. And that's what a lot of people are doing, riding the wave right now.
Yeah. So I think the thing with crypto, again, you can look at it like a stock, you can look at it short term, you can look at it long term. And like with stocks, it's quite volatile, but with crypto, it's much, much more. So like when we were saying a company could grow by 1,000% in the stock market when it had a recent IPO, crypto, for instance, can bounce 10,000%. So it's a ridiculous amount. But it can also drop. It can also completely crash. And because it's not something that's audited by an official stock market or exchange or by a government, when it goes down, there's no insurance policy. So it's very, very risky. But then if you look at the longer term, especially with the main ones, so Bitcoin, Ethereum, if you're feeling...
Helium.
Yeah, Helium, Polkadot, there's many, but like...
Dogecoin.
Not Dogecoin.
We don't invest in Dogecoin, guys.
Yeah, but if you are investing in like Bitcoin or Ethereum, these are going to be much more widely used in the long term. So yes, it's very risk averse right now, but if you're investing long term and you can get it in, and you can get in now while it's cheaper, again in 10, 20 years, it's going to be looking like a very healthy investment.
Yeah, and I think it is quite risky right now. So when people start out, maybe they shouldn't be investing in crypto.
Yeah.
You should start off with mutual funds, stocks, invest in crypto, and invest in secure cryptocurrencies like Bitcoin or Ethereum, where the probability of it going up is very high. Although like there are still fluctuations. Like I said, as long as you trust the market, it will eventually go up. You know? And the thing with Bitcoin is, right, so now obviously you shouldn't invest it again when it's at an all-time high. You should invest it when there's a dip. So with Bitcoin, we know that dips will happen, the bubble bursts, but then we know that the next peak will be higher than the peak there was before.
Yeah.
So maybe if it's at 60,000 right now, you should wait for it to get down to like 10 or 20,000, which will be the dip. Invest it then, and then the next time it goes up, it'll be at maybe 80 or 100,000.
Yeah.
You know, and that'll already be like a 500% increase in your money. So you should obviously time with crypto very well, and that way you need to like research cryptocurrencies, you need to research the market.
Yeah.
So it is a lot more research intensive, but again, there is a lot more reward there.
Yeah. So yeah, to reiterate that, crypto is very risky, and please don't go straight into it unless you know what you're doing.
Yeah.
And so like we said, we've kind of got a beginner, an intermediate, and an advanced level. So start with your mutual funds. They'll be your bread and butter. They'll be what help you in the long term. They'll help you buy a house. They'll help you plan your future. And then if you're feeling a bit more adventurous, invest in stocks, and that's the intermediate level. Test the water with companies that you know. Again, keep reading up about it, watch videos. And then once you feel like you're very comfortable with stocks, then you can go to the next level. Then when you look at cryptocurrencies.